Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known by many of you as Mr. Valuation. And really, that's what this video is going to be all about. I'm going to take a look at 10 what I consider to be high-quality, good-yielding dividend growth stocks that are trading at very attractive valuations, but also have some capital gain or total return potential built in. So kind of the best of both worlds, if you will. Now, I don't own all these stocks. I do own quite a few of them, and I do have clients in quite a few of them. But I think all of these would be worthy of a more comprehensive research and due diligence on any of your parts if you're looking for dividend growth plus capital appreciation. And I'm going to do these in order of lowest total return to highest, because I think that's important. But all of these stocks have decent yields and a combination of yield and growth, as I pointed out. But what I also want to talk about, not just the fact that these companies have these opportunities that I'm referencing here, but I also want to point out and illustrate where and how these opportunities have come from, because they're slightly different with each example. All of them are attractively valued. All of them have pretty decent above market yields. All of them have good quality. And the real key is I'm going to not just talk about how much money I think these stocks are capable of making for investors in the long term, and I'm talking 3 to 5 years or longer. I'm also going to give you the why I think these companies are, and I think that's really the important part of this message. So let's go ahead and get started. I'm going to start by pointing out the portfolio, and I've got it listed here in terms of lowest estimated total return. That would be a combination of capital appreciation plus dividend income to highest. And you can see my lowest here is the gas utility stock, UGI, and I'm going to cover a little bit about what they do if you're not familiar. Then I've got a couple of biotech stocks, and they're really quite different, Amgen versus AbbVie here. And there's really some big differences in where their growth is going to come from. You can see now my rate of return potential, or your rate of return potential, is getting up to 17%. Then I'm going to show Ameriprise, and this is one of the more interesting ones because it's not necessarily the best value that I have here. In fact, it could be argued that it has the least value, if you will, in terms of all these other stocks, the lowest earnings yield, or at least one of the lowest earnings yields, but yet it has the potential to generate, 20% plus long-term gains. Then I've got Bristol Myers, which I've covered. And I've been a little bit assaulted, and I said assaulted, so not insulted, to be clear, because I don't insult very easily, about Bristol Myers being a value trap. I'm going to try to really put that to bed here and also show you why Bristol Myers is such a good investment going forward and how it's not been a value trap for the last couple of years. And I'll even cover why I talk about why I would never consider this a value trap. Bank of New York Mellon is a financial I haven't really talked about much before. It's an asset management and custody bank, but it's really a regional bank, in my opinion, that's attractive. These might be the two least popular in some circles stocks I'm going to talk about. Obviously, the tobacco companies, Altria, also known as Philip Morris, or British American Tobacco. But these stocks really do have tremendous, capital appreciation opportunity. I'm going to, again, talk about why I believe that. And I'm also going to point out that these are two of the highest yielding stocks in this group in these top 10 here that I'm covering. Then I'm going to go into Manulife Financial and Prudential. Both of them are life and health insurers, and life and health insurance is very attractive. It's been kind of an unloved industry for several years, but the rates of return that both of these companies offer, I think, is really extraordinary. So without further ado, let's go ahead and start looking at these stocks one by one and start talking about why I think they're attractive and why and how I believe the rates of return are going to be created. Now, the first one is UGI, and a lot of people aren't familiar with this stock, so I'm going to take a second here and go into their website and point out that many people know them by AmeriGas, which is the LP distributor, the nation's largest propane distribution. You can see the AmeriGas canisters in almost every convenience store and anywhere that they sell those kind of things. But then this company works internationally, but they also work heavily in the U.S. through AmeriGas. So it is a gas utility stock. And the reason I wanted to show this was because I actually had a comment and a question showing stocks that have been overvalued that actually reverted to the mean. Well, this is a classic example of that, because as you look at this this stock, first of all, it's had 10% historical earnings growth, which is very, very strong for a utility stock. You can see how the stock price has tracked earnings, which is the orange and the blue line on this graph, both of them, representing about a 15 multiple. The blue line obviously slightly higher. And you can see there were periods of undervaluation where the stock was real attractive. And then it did get, pretty pricey in 2017 and 18. Now, keep in mind, this is when people love stocks, when they're rising like this. But then, they did have a down year in 2019. This company has a September fiscal year, I might point out. And then the stock price really collapsed. And this is when nobody wanted to own the stock. And obviously, this would have been the best time to buy the stock. And I show this because it's already had two reversions to the mean. It reverted to the mean from being significantly overvalued with a PE of 22 in January of 2019. And then the PE dropped to 11 by March of 2020. And now it's reverted to the mean and it's back to a 15 PE. So I consider this stock just reasonably valued today. From a forecasting perspective, the company is still expected to grow at 7% a year. So the only reason why this 8.11%, lowest total rate of return is here is because it's a combination of growth plus the dividend income, and the stock yields 3.03%. The key is here that this one is actually fairly valued to even, you could even argue, well, I wouldn't call it really fully valued. It's certainly not overvalued. But the point is, there is, the margin of safety would have been had buying it, down here. But the point is, it is on the upswing and it does have growth going forward and it does offer a 3% dividend yield. So this could fit a portfolio that's looking for current income. This could also fit a portfolio that's looking for some, capital appreciation to go along with it. And again, it's a very good quality company. If I look at the historical performance of this stock, it has massively produced more income than the market. Its rate of return has significantly outperformed the market. I'm going back here till December of 2000, comparing it to the S&P 500, and it's also generated significant capital appreciation. The point is, though, back here it was trading at about 12 or 13 times earnings and grew at 10%. Today, it's trading at almost 16 times earnings and only forecast to grow at about 7%. So obviously, the future expectation here won't be as strong as what we've seen historically. But nevertheless, it's a good, solid valuation right now in a very, very overvalued market, as I've talked about quite a bit over the last several videos. The market is extremely high right now. The next company I want to show is Amgen. Now, I really like this company. There's a couple of things I want to talk about here, and I'll be talking about this more in future videos. But what happens with really strong growth stocks? Amgen, years ago, going prior to the Great Recession, was a very, very strong growth stock. It was a biotech stock, and I want you to notice earnings growth was 12%, 18, 37, 26, 33, 22. And then, it started to slow down to 10. The historical growth has averaged about 13.46% over this time frame. But I also want you to note that when the stock was overvalued coming into the recession of 2001, trading at an incredible 62 times earnings, despite all this wonderful growth, shareholders made in fact, they lost money owning this stock over this period. This is about 6 or 7 year period I'm showing you here. But then once it did revert to the mean, as I showed you, what happened to UGI here more recently. Once it reverted to the mean, of course, everything was cheap during the recession. We acknowledge that, but you could have bought this stock at a 10 multiple, and this would have been maybe one of those proverbial value traps. Actually, let me backtrack this a little bit just to try to make this point. You could have argued that this stock was a value trap because it made a negative rate of return for, roughly a 2-year time frame here, a little more than that, during a time when their earnings were actually growing a little bit. But another thing that happened here, the thing that a lot of people don't, I want to make you aware of, growth stocks tend to morph into dividend growth stocks, especially when their growth begins to slow down. And you can see Amgen started paying a dividend in 2011 with a very low payout ratio of about 10%, as you can see at the bottom of the pop-up. But then over time, that payout ratio has increased up to 30%, and it's hovered around that 30 to 40% range for the last couple of years. But the real opportunity here, a couple of things about valuation and how valuation works. It was very, very undervalued here in November of 2011. And had you bought it and held it through roughly yesterday's close, you'd have averaged over 18% a year. I also want you to notice this, volatility. The price has been up and down, up and down, up and down, up and down. You could call these reversions to the mean, but this stock never got terribly overvalued and never got terribly cheap. Of course, when it was inexpensive, when the PE did get down to 10 or 12, these were the optimum times to buy it. This is the times where you really, enhanced your rate of return dramatically over buying it, let's say at fair value, where your rate of return would have dropped into less than double digits, or when it was really highly valued back here, where your rate of return would have dropped down to 7.5% or so, even though the company actually did extremely well. So valuation matters, as I said in my last video, and it matters a lot. But I wanted you to see a couple of things here. Overvaluation can kill you. That's why I'm so adamant about these overvalued stocks, especially the tech sector that's out there today. Big companies tend to slow down. This is now a $136 billion market cap company. And when they do, it's very hard for them to find, places to put their money, their huge revenue streams. And so they tend to start morphing into dividend growth stocks, as Amgen did. But regardless, Amgen has, a very nice rate of return going forward of about 9.5 to 10%. It's an A- rated company, extremely high quality biotech, actually the world's largest biotech, and it, very, very attractive from that point of view. The next example here would be AbbVie, and AbbVie is the spinoff from Abbott Labs. I've covered this stock several times. Here you see a company that traded, at around a 15 multiple, had many reversions to the mean, we'll call them. When it got overvalued, the price always wants to move to this valuation. Now, in the last couple of years, a lot of things have happened. And with this company specifically, you got this Humira coming off a patent. That's really why we see earnings expected to fall off in 2023. But in the meantime, the stock has become very, very inexpensive. And, if you measured it from here to here, there are those cynics out there that might even call that a value trap. If you measured it from here to here, which is, just a matter of a few months or maybe a year's time here, then all of a sudden the stock is clearly a value trap in the minds of many people. But that's short-sighted and short-term, in my opinion, because if you measure it from here, when it got really cheap to here, it's now over the last, almost 2 years, it's been an absolutely monster of a performer, generating a 40% annualized rate of return. Now, going forward out for the next couple of years, which is about as far as I want to go, this stock has actually a 48% potential rate of return. Even if Humira, the patents go off cliff and it does, have a couple of down years and a flat year of earnings growth, you still have a 17%, rate of return potential stock here. And that's where these numbers that I'm giving you here are coming from. They're coming from the forecasting calculator, just to be clear about that. So AbbVie looks very, very attractive, 4.65% dividend yield, almost a 10% earnings yield. The company is BBB plus rated, and I believe it's an excellent candidate, and it is on the upswing. Call this a value trap. It's been moving along very nicely for the last couple of years, and I think the stock is still extremely inexpensive. Even if you measure it at its more normal multiple, you still have very substantial long-term rates of return going on AbbVie. So that's one you might want to consider. The next is Ameriprise, and I wanted to show this one for a couple of reasons. A lot of the performance that I've been talking about so far has really come from stocks that are so significantly undervalued that they have a built-in margin of safety. And when there is a reversion to the mean on the upside, that they're going to get some what I call natural leverage or financial leverage. In the case of Ameriprise, this one is all about growth. The company's historical growth has averaged about 11%. I shortened the time frame going back to 2014. It's up to almost 13.6% or 13.58%. Now this company has already, it did get very inexpensive, and I guess you could argue during COVID here, and then it's really rallied quite strongly. But look at the growth potential that is currently being forecast for Ameriprise Financial. So we've got 50% growth expected for this year, followed by 7% and 11%. So this 20% plus rate of return that I showed, in this first portfolio review I showed you is really a function here about growth and not so much, valuation. It's attractively valued, but the real play here is growth. The dividend yield's only 1.76%. So the majority of this 20% rate of return is going to come from capital appreciation. But I want you to note something else here about this stock, which I think is very interesting. If I look at analyst forecasts, it was, $18 a share for this fiscal year 6 months ago. Then it went up to $19.49 3 months ago. Analysts were adjusting their estimates up. Then it went to $19.80, the most previous estimate. Now it's up to $21.10. So estimates have actually been increasing rather substantially for this company. And there are, a reasonable amount of analysts, 13 analysts making these forecasts. And again, this is about as far as I like to go out at just a normal, P equals growth rate, 16.17 multiple here. This stock could generate 25%. Even at, slightly less than a 15 multiple here, it would still be a 17 or 8% grower. And the company's A- rated, so I think it's one of the higher quality ones I'm showing you here. Very attractive, and it's already had a good run. Now, this one I want to have a little fun with because I do have a subscriber that likes to throw little nicks at me here and then. And the last one I got from this particular subscriber, and I'll leave it nameless, said, it's been a value trap for several years. Well, Bristol Myers hasn't been a value trap for these reasons. Number one is you've got to know where the bad performance comes from when you're making judgments about stocks. Clearly, this company became significantly overvalued, despite the fact that their operating performance wasn't really that good during this period of time. Markets aren't always rational, so we had this very significant overvaluation. So from, July of 2016 to current, this stock has been a quote-unquote value trap simply because it's generated a negative rate of return, but that's functionally been a result of significant overvaluation. So I'm going to shorten the graph here quite a bit. And I want to point out that since 2015, this company's grown earnings at about 18.35%. That immediately discredits it as a value trap. Again, but we had significantly high valuation. Even if I go back 12 years on this stock, it still grew by 11%. That includes some weak periods in 2014 and 15. So here we have a business that's growing, very nicely. We have moderate dividend growth. I will give you that, but the yield is almost 3% and the stock is significantly undervalued. But here's what I want to point out. If we measure this stock from its trough in July of 2019, and go out here to April of 2021, so, somewhat over a year, Bristol Myers has been generating a 29% total rate of return with a very strong dividend yield to go with that. Even from the standpoint when it was fairly valued, if I measured it to now. It hasn't been awesome, but it's been a 5% grower. But any time that I could have bought it when I had a margin of safety, I started to get, double-digit, very strong, 15 to over 30% rates of return. That's hardly a value trap, and the real key is it's functionally related to the fact that this stock always traded at a very high multiple and even, a 15 multiple or higher. So if I go into my forecasting graph, I'm looking at 6.5 or 7% growth going forward. But I have this enormous rate of return potential, and of course, the closer period of time, the rate of return potential is extraordinary, assuming this stock moves back to a 15 PE. If I look at the normal multiple, it's been closer to 17 times earnings. In other words, that simply means the market has put over the last 5 years has had a higher multiple in this stock. Now we get staggering rates of return from this company. And again, we've got almost a 3% rate of return. But you can see the market has rarely traded this stock. Right now, it's got a PE of 9.76, which is obviously one of the lowest PEs it's ever traded at. And if I pick any of these more normal PEs, I'm going to leave it at this 16.9. Well, let me move it to the 15.7 PE, which I've now added here, to the graph so I can run that. You still have this multiple, 20%, 50% annualized rates of return, depending on where you're looking. This is an extremely attractive A-plus rated high quality company with a good yield. And here your return is going to come primarily from that reversion to the mean that I often talk about, or the fact that this stock moves back into alignment with its intrinsic value and even with its historical normal values. So Bristol Myers looks very good. Now, Bank of New York Mellon is one I haven't talked about much. And I like showing this again because, if you analyze these different sectors, it was very overvalued up here. And see, to me, the real value trap is the overvaluation, not this undervaluation that people always want to relate to a value trap. This is where you have a value trap when the stock is ridiculously overvalued. When the stock gets undervalued, that's when you really have good opportunity. So even if I'm measuring this stock from a PE of 8, to the PE of 12, I'm getting a 12.5% rate of return, even though the stock is still undervalued. And again, this is primarily COVID related, this one drop in earnings. The company is expected to return to double-digit earnings growth going forward, offers a 2.5% yield. It's A-rated, only has 20% debt to capital, and the real rate of return potential here is a function of some undervaluation coupled with double-digit expectations for growth going forward. So there's different ways that these performance calculations I'm sharing with you can happen with these companies. I think it's important you recognize that. Moving on now, I'm going to cover briefly the tobacco stocks. What I wanted to show was people asked me, I have been recently asked by a subscriber in my last video, can you show me companies that reverted to the mean and now have become attractive? Well, I want to point something out. When a stock is overvalued and it's hot, when it's a hot stock, it can tend to stay overvalued. Here, Philip Morris stayed overvalued, or Altria, excuse me. I always want to call it, MO is Morris. It's the old Philip Morris. But anyway, when a stock has got momentum, that momentum can stick. In this case, it lasted about 4 years. But then once it got out of favor, you can see the price started to drop here, and that lasted another 3 or 4 years. But now we're starting to see this recovery. But you've got a 7% yield, triple B rated company. Tobacco is obviously a tough commodity here, but the company's paying out almost all of their profits to you in earnings. And and it's got good potential going forward. Growth, now this is critical. Historically, this company has grown at about 8% a year. Okay, which is very consistently, I might add. The Biden administration has banned menthol, and but of course, when they did that in Canada, all the people flocked to just left the menthol cigarettes and went to the non-menthol cigarettes because people like their cigarettes. But the point is, whether you're in favor of tobacco or not, and I'm not a big fan, I do own this stock. I have recently put this stock into portfolios because it's such a high quality company, it's such a good valuation. I couldn't resist it, but I did it under protest, I will say that. But here's what I wanted to make the point. Future growth is expected to slow down to only about 6%. And that's taken into consideration a lot of the issues out there. And of course, they've gone through litigation and everything else. But your rate of returns on Altria are extremely attractive going forward with a wonderful dividend yield while you're waiting. And the same would be said about British American tobacco. It's extremely inexpensive. It was pretty overvalued not too long ago. It's gotten cheap, and it hasn't gone anywhere in the last year or so, but the business has continued to perform. And some of this erratic dividend, I'm sure, has to do with this is an ADR, an American Depository Receipt, and, it does trade on the New York Stock Exchange. So the bottom line here is we're looking at some, possible currency conversion issues, but even at a 13 multiple, this stock has a potential to generate strong rates of return with a 7.88% dividend yield. So if you can get over the tobacco thing, clearly this stock is traded at high valuations. The risk of investing in this tobacco stock as well as Altria, in my view, are already priced into the stocks. And then Manulife is simply another life and health insurance company that traded at, historically it traded at 15 multiples. More recently, it's been trading at 10 or 11 multiples. You can buy it today at a 9 multiple with an 11% earnings yield, dividend yield of 4.18%. And I might add a dividend that's grown at about 6% a year. So this stock is actually, I think, very, very attractive from a standpoint of valuation as well as growth potential. The rate of return that this company is capable of generating, which is very high over the next couple of years, is really functionally related to the stock reverting back to a more normalized 15 multiple. And, even if it only moves back to a 10 multiple, which is what I'm showing you here, you still have 39, 20% annualized rates of return out for the next several years. So I believe there is a very strong margin of safety. It's a very high quality company, A-rated with only 21% debt. And then the same could be said about Prudential. Now, Prudential, A-rated with 20% debt as well. I'm showing you the long-term graph here because I wanted you to see a couple of things. The company traded strongly at a 15 multiple for years and years and years. The reset happened during the financial debacle, the '08 recession. You can see the price followed earnings just almost perfectly here. But then a lot of these financials have never come out of this 10 to 12 multiple slump that they've been in. But even now, you can buy Prudential, this extremely high-quality insurer, at 9 times earnings with a 4.6% dividend yield and a whopping 10.7 earnings yield. When I look at the future here, we're expecting growth to kind of reestablish itself at somewhere around 10% a year. I believe that can easily justify a 15 multiple and mean that we can make staggering rates of return going forward. If it stays down, in this case, even at an 8 multiple, it's got double-digit returns. But if I use my pop-up here, 8 or 9 multiples have been, rational over the last, say, 10 or 15 years since the Great Recession. But even if I go back to a 10 multiple, which to me is still extremely inexpensive, I've got 40% capital gains. And again, I've got an A-rated company with very little debt and extremely high quality, a little bit cyclical, but it's had average growth that's very strong. It's forecast to grow almost double digits again, and you can buy it for a song. Anyway, this has been Chuck Harville saying, hope you enjoyed looking at these 10 dividend growth stocks that have high rates of return. And also I wanted to show you the different ways that these returns can happen, just to give you a little more insight into how investing in dividend growth stocks works. Thanks for watching. If you liked the video, give me a thumbs up, ring the bell, give me a like, and subscribe to the channel if you haven't already. Thanks for watching.